The recent banking crisis has highlighted the importance of grasping and controlling the systemic risk, and the acceptance by central banks to ease their monetary policies for saving default or illiquid banks. This last point shows that banks would pay less attention to liquidity risk, which, in turn, can become a new important channel of loss. A small bank is not considered as potentially systemic. However, the interaction of small banks altogether can become a systemic element. This paper analyzes the impact of medium and small banks' interactions on a set of banks which is considered as the core of the network. The proposed method uses the structure of an agent-based model in a two-class environment. All banks are active on the European interbank network and have deposit and market activity. A simulation of 12 three-month periods representing a midterm time interval of 3 years is projected. In each period, there is a set of behavioral descriptions. The central bank is considered as a lender of last resort, which allows banks to borrow at repo rate, and some ejection conditions of banks from the system are introduced. 3 different liquidity crisis scenarios: asset variation, forced illiquidity in specific banks, and a trust crisis have been simulated, and the loss impact on bank classes is analyzed through aggregate values representing the aggregate of loans and the aggregate of borrowing between classes. It is mainly shown that the 3 groups of European interbank network do not have the same response, and that intermediate banks are the most sensitive to liquidity risk.